Welcome to the deep dive. Today, we're cracking open the corporate archives, really getting into a piece of history. It's often cited as, the gold standard for transparency during tough times.
Right, we're talking about the 1992 shareholders letter from Fairfax Financial Holdings.
Exactly.
And this document, it's absolutely essential reading if you're interested in how value-focused management handles real adversity. We're not just looking at numbers here.
No, not at all.
We're sort of dissecting the anatomy of a strategic reset. It followed a year the chairman himself actually called disappointing.
And that's our mission today, isn't it? To understand how a company that's all about long-term compounding navigated, well, a really severe downturn. We're using only this incredible self-assessment from the 92 source material.
Yep, sticking to the source.
And to set the scene, we have to start with the ugly truth right up front.
They definitely didn't bury the lead on this one. The headline numbers were, frankly, brutal. 1992 was the first time since 1985 that FFH failed to meet its big objective.
That goal of earning over 20% on shareholders' equity.
That's the one.
I mean, that's not just a miss. For a company operating at that kind of standard, it's a dramatic collapse. Their return on equity, it dropped all the way to 7.7%.
Ouch. And net income fell by more than half, a 56% decrease.
Yeah, from $22.5 million in 1991 down to just $10 million in 1992.
So when you look at those figures, the big question is, how does management maintain credibility? How do they keep shareholder faith when they've missed their own target by such a huge margin?
Well, that's where the structure of the letter itself is, I think, a masterstroke. They immediately pull back the camera lens, give you the context, remind shareholders it's a long game.
It's the classic hanker and volatility, isn't it? They acknowledge the disappointment of that single year, yeah, but straight away they state that their average annual return on equity over the whole 7-year period, 85 through 92, still stood at 21.5%.
So cumulatively, they were still ahead of their own objective.
Exactly, despite the bad year.
And the book value growth, that's the real story here. The letter notes book value per share actually increased 11% in 1992. But look at the total growth.
Oh, yeah.
That figure shot up from just $2.08 in 1985 to $23.76 in 1992.
They calculated that as a compound growth rate of about 40%, which is just, wow.
And they wisely added the disclaimer, didn't they? Something like, we don't expect to repeat that.
Well, quite. But what's fascinating is how they justify keeping that 20% hurdle.
Yeah.
They actually reference a professional survey, the Report on Business.
Right.
It found that only 39 out of the top 1,000 Canadian companies had earned over 20% on equity over the previous 5 years. In Fairfax, they were ranked 22nd.
So by citing that external benchmark, they're showing you, the shareholder, that the 20% target isn't just some arbitrary number. It's genuinely tough. It's aspirational.
Precisely. It sets that philosophical tone, like, we are committed to excellence, this year we failed, but the standard itself, it's still valid.
It shows management's committed, even when they trip up. And that long-term track record, it gives them the moral authority to say, okay, we messed up here, but trust the framework.
Yeah, building on that need for trust, 1992 wasn't just about financial setbacks. It was really about internal discipline, too.
Yeah.
Management made some major strategic moves.
Designed to clean up these long-standing structural issues, right? Things that might erode confidence over time.
Exactly. Strategic housekeeping, you could call it.
Okay, so let's unpack the first big one. The acquisition of Hamblin-Watsa Investment Counsel, or HWIC.
Right. Now, this firm was co-founded by the chairman himself and managed about $1 billion in assets.
Including $250 million from Fairfax's own insurance subsidiaries, which, yeah, that screams potential conflict of interest.
It certainly does. And the way they resolved it, it's a real case study in governance. They acquired HWIC for $13 million, part cash, part shares, priced at 28 days.
But the process, that's what really stands out.
Totally. To ensure fairness, they put the whole thing through an independent committee, chaired by Robert Hartog. They even consulted Sir John Templeton.
The dean of the investment counseling business, as they called him.
That's him. And then they required approval from the majority of minority shareholders.
Wow. That level of due diligence, that third-party oversight, it's incredible. It sends a clear message. We might have had a rough financial year, but our commitment to clean governance, non-negotiable.
And the rationale was pretty straightforward. It was seen as a good investment. They expected 20% returns, but more importantly,
it centralized everything, put all the chairman's investment interests into one pot, eliminated that perception of self-dealing.
Exactly. And there's an interesting accounting detail in Note 16 we should probably mention.
Oh.
The purchase price was almost entirely goodwill. And they committed to amortizing that goodwill over 10 years.
Which is quite conservative, isn't it? Even if they expected the goodwill value to hold up.
Very conservative. It just adds another layer of financial prudence to the whole deal.
Okay, so the second strategic move was smaller, but equally thoughtful maybe. The 62 Investment Company Limited acquisition.
Right. This one was purely a mechanism, really. It was to provide liquidity for the original 1985 investors.
The ones who backed the company when it was, well, almost bankrupt.
Yeah, the real early believers. And it was a smart, low-cost maneuver. By acquiring a 49.9% interest, Fairfax effectively repurchased about 120,000 of its own shares for what they called no cost.
Which gave an immediate boost, about 2%, to both book value and earnings per share.
It's like a thank you note and a smart capital allocation decision all rolled into one.
And the chairman used that moment in the letter, didn't he? To sincerely thank those early backers for supporting an almost bankrupt insurance holding company led by a chairman with no corporate experience at all.
That little touch of personal humility, it really humanizes the whole corporate account, makes it feel more real.
Okay, so if Section 2 was about cleaning up structures, the next part. This is about the painful admission, violating their own core philosophy.
Yeah, this is where they detail the costly, long-term lessons learned from speculative venture capital.
They didn't tiptoe around it either. They announced they were definitively closing down their investment banking area, getting out of venture capital for good.
The main failure they highlighted was the Carbovin loss. They had to make good on guarantees $5.75 million worth.
Which brought the total cost of that venture since 1988 up to $14 million.
And the brutal summary was...
Nothing to show for it. Just imagine that conversation in the boardroom.
Right. The self-assessment in this letter is truly humbling. The chairman calculates that his own attempts at brilliance in these speculative ventures,
Carbovin and Develkin combined.
yeah, had cost the company about $18 million pre-tax, or $3 per share, cumulatively.
He put his own failure in bold type for everyone to see.
That's the ultimate test of transparency, isn't it? And it took them, what, 5 or 6 years to fully get out of these illiquid speculative bets.
That timeline alone just emphasizes the risk.
And this failure led to a really definitive, hard-won shift in philosophy.
The quote is just indelible. They state, "You can be sure we will never get into a venture capital investment again. Unfortunately, it was a costly lesson we prefer to learn from the mistakes of others."
It's like the sound of a value investor just slamming the door shut on anything that even smells like speculation.
And it connects right back to their investment framework.
Absolutely. Venture capital, it requires that unreasonable conviction, often without a clear path to free cash flow.
Huh?
This painful loss just reinforce their core discipline. Stick to investments that are liquid, understandable, and trading at a discount to intrinsic value.
And $18 million was the tuition fee for that clarity.
You could say that. A very expensive lesson.
Okay, let's shift gears to the operational core insurance. 1992 was tough globally, and Fairfax took a hit, an almost $17 million underwriting loss.
Which pushed their combined ratio up to 114%.
Right. Now, for anyone listening who isn't, steeped in insurance finance, maybe unpack that. What does a combined ratio of 114% actually mean?
Yeah, that's crucial context. So the combined ratio basically measures the profitability of an insurer's core underwriting business. It compares how much they pay out in claims and expenses versus how much they take in from premiums.
Okay.
Anything over 100% means they're losing money just on the underwriting itself. So 114% means for every dollar they took in premiums, they paid out a 114 cents in claims and costs.
Yikes. Okay. So what drove that? Was it just poor underwriting judgment, or were there external factors at play?
It was largely an external catastrophe. The main culprit was Hurricane Andrew.
Ah, Andrew, right.
That single event cost their subsidiary, Commonwealth, about $11 million. And the letter makes a pretty compelling case. If you took out Andrew's impact, Commonwealth's combined ratio would have been 98%.
So firmly profitable instead of the 122% they actually reported.
Exactly.
That sounds like a decent defense, an act of God. But hang on, isn't it kind of an underwriting failure if you're that exposed to catastrophic risks like Andrew and maybe you haven't provisioned enough? How do they defend their structural risk management?
That's where the strategic capacity argument comes in. They admit they got hit, sure, but they point to their very low operating leverage as their structural advantage.
Okay, operating leverage, another one of those technical terms. Let's break that down. What does low operating leverage mean for their subsidiaries, like Commonwealth at 0.6, 0.1?
So think of operating leverage as The relationship between the premiums they write, basically, how much risk they take on, and the equity capital they hold underneath it.
Okay, a cushion.
Right. Most companies might run leverage of 2.1, maybe even higher. But Fairfax's subsidiaries, like Markel, which was at 0.9.1, carried way less debt and kept a much bigger cushion of equity capital relative to the risks they insured.
So their long-term advantage isn't necessarily maximizing profit in the good times.
Right.
It's having the capital ready, that firepower, when the cycle hits rock bottom.
Exactly right. When the insurance cycle finally turns in the letter notes, they saw signs of it, but it wasn't inclusive yet. Fairfax has the balance sheet strength, the capacity to massively increase their premiums.
They can rush in when their leveraged competitors are forced to pull back and raise prices.
That's the hallmark of countercyclical investing.
Mm.
They're built for the downturn, in a way.
Okay, turning to their investment portfolio. 1992 was described as, one of the worst years for Canadian value stocks?
Yeah, pretty bad.
They disclosed $17.4 million in unrealized losses, about 4.4% of the portfolio. How did they handle that, that psychological blow?
They stuck to their guns,
Yeah.
maintained strict investment discipline. The chairman was adamant that unrealized losses or gains are fluctuations and do not have any predictive value.
And he backed that up.
He did. He gave concrete evidence. Their $34 million unrealized loss from 1990 had almost disappeared by early 1992. It confirmed their view that volatility is mostly noise, not necessarily fundamental deterioration.
But they didn't just ignore losses completely, right? They stayed conservative.
Absolutely. They took a $16.3 million provision for investment losses, specifically to account for permanent impairment.
Like the Woodward situation.
Exactly. The full $2 million write-off for Woodward's after that company filed for protection from creditors. That distinction they make between temporary fluctuation and permanent impairment is just essential to their whole value philosophy.
Okay, this commitment to discipline, it extends right into their capital management philosophy, doesn't it? Especially their famous view on dividends.
Oh, yeah. Their dividend test is extremely strict. They basically say they will not pay dividends as long as two criteria are met.
Okay, what are they?
One, they're earning that 20% on equity target. And two, they believe every single dollar they retain can generate at least $1 of increased market value for you, the shareholder.
And that second point is key because the market value increase is essentially tax-free growth.
Right. It's the ultimate retention policy. They're basically saying, we think we're better capital allocators than you are, so let us keep it and compound it.
And coming out of a tough year like 92, what was their immediate financial priority for 93?
Laser focus, bringing short and long-term debt down from about $47.7 million to around $30 million. It's clear they wanted to use the next profitable year to immediately deleverage, repair the balance sheet.
And since they don't pay dividends, what's their main way of returning value to shareholders?
Share buybacks, plain and simple. They see repurchasing shares, especially when the price is near or below book value, as the single best use of capital.
And they walk the talk on that.
Definitely. They noted that cumulatively, since they started, they'd retired about 2.1 million shares.
At an average cost of just $9.80 per share.
Which was, what, about 34% of the shares outstanding at the time of the letter?
That's huge. Retiring that many shares shows a real long-term commitment to disciplined capital allocation, especially when they think the market's undervaluing their assets. This whole letter, really, it's a masterclass in using adversity to actually strengthen conviction.
So what does this whole 1992 deep dive tell us about that core value investing mindset? I mean, it was clearly a year of reckoning for them.
Yeah, no doubt.
External crises like Hurricane Andrew forced some operational humility, and those internal failures, especially that $18 million venture capital loss, forced a major strategic cleansing.
They admitted the failure of speculation, but at the same time, fiercely defended the structural framework of their insurance capacity.
It really all comes down to conviction versus evidence, doesn't it?
How so?
Well, they hold firm to that big 20% objective, even while admitting the evidence for their $18 million venture capital foray was inadequate.
Yeah.
Painfully inadequate.
Right. And the chairman even quotes that definition of an entrepreneur near the end of the letter.
Yeah. Unreasonable conviction based on inadequate evidence. Fairfax was founded on exactly that premise and achieved extraordinary returns because of it.
Which brings us to our final thought for you listening. This tension, this push and pull between conviction and evidence, it really defines leadership in a crisis. When you look at this 1992 letter, you see a management team that suffered a really significant self-inflicted wound, that $18 million loss, yet they maintained their aggressive long-term goal and kept that reserve capacity ready for expansion.
So the question to ponder is, how much of true conviction is realizing when the evidence was inadequate, accepting the cost, and course-correcting immediately?
Like they did with venture capital.
Exactly. Versus how much is about stubbornly holding firm to the ultimate, maybe even unreasonable, long-term vision?
It's that balance, finding that balance, that really made this difficult year so defining for them.